plan. You must have a plan. And then, of course, how to start building your plan with the special seminar we're going to be giving an offer on later in this presentation. So what is swing trading? Well, it's technical analysis. It means using the charts. You want to use the charts to determine when to buy and sell. I don't care if you love a stock, if you think it's the next greatest thing in the world, it's the next big Starbucks, it's going to take off. If the charts are terrible, you're wrong, because the charts don't lie. So that's why we use swing trading and use technical analysis to determine when to buy and when to sell. As you can see here, this would be an ideal chart that goes up and down. As you note, everything in life does not go straight up. You're going to have pullbacks. This is resistance every time it bumps its head, and this is support. An ideal uptrend has what we call rising highs and rising lows, meaning every time we make a new high, it's going to be a little bit higher. Every time we pull back, it's going to be a little bit higher. So ideally, what we want to do is catch these swings. Buy here, sell here. Buy here, sell here. That's ideal. It's not realistic. It's ideal. But that's what we're trying to capture. We're trying to capture the swings in the market. This swing here may last a few days. We had a position we sold in 6 days and made 6%. We were happy with that. 1% a day. You can't go wrong. Sometimes this swing will last weeks, if not months. So a lot of times people ask, Matt, what's your holding period for MarketForce? I said, you know what, I can't give you that because, again, it may last a few days because it may go in our favor dramatically, very quickly, or it may go against us very quickly and we have to get out because I was wrong. At the same time, we may be investing in a mega trend that may last for months or maybe last a year. I've got into trades with clients that have lasted over a year because the trend continues to go higher, and what we do is we let our winners run. You cut your losers short, but you let your winners run. So the goal here is to catch the swing. Time frame on a swing, we don't know. We let the market dictate that. Commandment number 1, identify the current trend of the market. I want everybody to type in on the side what they think the current trend of the market, and Kyle can jump in and let me know where the consensus is. The current trend in the market is up in my mind. I mean, we closed at a new all-time high in the S&P 500 on Thursday. Sure, we pulled back a little bit this week, but we closed at a new all-time high this week. So it's tough to fight that trend. So we identify that right away. So then what we do is we go down to a macro to micro, top-down approach. Some people look and they buy stocks because it's got good fundamentals or good chart. Well, the thing is, if you're buying a stock because it has good fundamentals, you would have been buying a lot of stocks after that crash just started in 2007. Little did you know there was probably another 40% downside on that stock until it hit a bottom, and you probably got stopped out. That's why I use top-down, because you look at the market itself. If the market itself is in a clear downtrend, the odds of you picking a winning stock or winning ETF fall dramatically. So that's what we use here at MarketForce. We use a top-down. Right now, clearly the top is bullish. A lot of sectors are bullish. So that is why we are invested in the market right now and heavily invested in the market and overweighted in equities. So as I mentioned already, an uptrend, higher highs, higher lows, lower highs, lower lows. This is just a chart of a stock that I thought was probably the quintessential uptrend. It's proof point, the symbol PFPT. Don't own the stock, I'm not recommending it, but I just thought it'd be a great idea of an uptrend. As you can see, this is real life. Higher highs, higher lows, but it does pull back. And you always have to be patient. Every couple of weeks you get a little pullback, and that is why you don't chase. You follow the trend, but you wait for your pullbacks and wait for your entry point. Commandment number 2, trade the mega trends. What I mean by this is, in my second book, The Next Great Bull Market, it was all about mega trends, investing in the big trends for the next 5 to 10 years, if not longer. We want to think big picture. So you think right now, what are some of the mega trends going on in the market? Some may be big trends. Some may be niche. One of them that I'm looking at is the auto industry, the global auto industry. And you think to yourself, why? You know, why car stocks? I mean, didn't the U.S. government just bail out GM a couple years ago? Same with Chrysler. Ford was in deep trouble a few years ago. Sure. But things have changed. And, you know, I personally have not invested in auto stocks in a very, very long time. But I started thinking, well, here's our big picture. Big picture is the average age of the vehicle on the road here in the United States is over 11 years old. It's the oldest we've ever had. You know, vehicles last longer, but 11 years is pretty old. So I think to myself, well, they got to start buying new vehicles. Interest rates are still extremely low, and they remain low on auto loans, which is very bullish for people who want to go out and buy a vehicle. We've seen a major turnaround in Europe. Car sales, this past month, they dipped down a little bit, but they were very good the prior month, and the trend has been better. Same thing here in the United States. that they're saying overall globally, auto sales may tick back above 16 million in 2013, which would be the first time it did that in 5 years. So we are clearly seeing the trend move higher in auto stocks. Then what we must do, as it says here, the charts must confirm the mega trend. And that's where we come down here. This is the First Trust Global Auto ETF. It's a basket of the big auto stocks, symbol CARS. You gotta love these symbols. You can't forget it because they make them simple for you. CARZ. Look at the trend on this. The trend is great. The chart looks great. This is an ETF that meets the big mega trend. So this is the type of stock, or ETF, I'm sorry, that we could buy and own for maybe a few months because it does well, maybe a couple weeks, maybe a couple days. I'm wrong and all the auto stocks crash on Monday. Or it could be something we hold on to the long term because I think this is a mega trend that could last. So this is how we come up with a lot of our ideas. And in MarketForce, as subscribers, we share a lot of these mega trends with you, and we identify these mega trends and we find the ETFs that will take advantage of these mega trends. And at the same time, what's key is I can give you all the mega trends today, but you have no idea when to buy and sell. We give you real-time alerts when to buy and sell, when they get out, and that's where expertise in the charts and determining when to buy on these pullbacks, and do that for you. Commandment number 3, patience is a virtue. Anybody out there have patience? Because I have absolutely zero. You ask anybody in my life, friends, family, I'm the most impatient person in the world. I live in New York City, okay? So think about that. I'm living in New York City. I walk to the gym. It's about 3 blocks away, Columbus Circle, right by Central Park, tourists everywhere. It takes about 5 minutes. If it takes 6, I'm pissed. It took too long because there's too many people in my way. I have zero patience. My day is down to the second. Well, when it comes to the market, I learned the hard way many years ago that I have to have patience, and I do have patience. And I will tell you this. All successful traders and investors have certain qualities. One that they all have is they have above average patience. Nobody's perfect when it comes to patience. I'm not as well. But you have to have patience, and the only way you can have that patience in the market is to have a system. Have a system that has been proven to work in the past and have faith in that system. This system I'm showing here today, and I'm about to get into the 3 strategies in a moment. What I'm showing you here today, this is a system I've been using for over a decade. Sure, it doesn't work every day. Nothing works every day, but for the most part, it does. Over time, it does. And it's just like going to sitting at the casino in Vegas. When you sit down at a table, you want to put the odds in your favor. This system puts the odds in our favor. I have faith in it, so I have patience. When sometimes we buy an ETF and it's down for the first couple of days, you know what? Nothing goes up right away. You know, if it's that easy, I wouldn't be sitting here talking to you. So you have to have faith. You have to have some patience. And what you can't do is overthink. People overthink the market because they want to know every day. I get asked every day, mostly on television, Matt, why was the stock market up today? I have no idea. I don't know from day to day. Why was it down today? Who knows? No reason, because it wasn't up. I mean, you don't have to have a reason for something to be up and down every day. Sure, it's a news-driven market, but it doesn't have to be something every day. So do not overthink the market. Do not try and find a reason why this trade is working or is not working. Sometimes you're just wrong. You're flat out wrong. And if you are, get out of it. If you're not and you still believe in the system and you still believe in the trade, then you stick with it. I want to show you an example here. This is a real-life example of a stock that I bought for clients. I bought on, this is SWM symbol, on February 5th at $40.40. Within 2 days of that, it came out some bad news, it gapped down. We had a 12% stop loss on this. I'll talk about stop loss later in this webinar. If it's down 12% or more, you know what? I have to admit I'm wrong. I need to get the heck out of the position. It never broke our stop, so I stuck with it. The fundamentals were still good. Longer term, the chart was still good. It just had some bad news. I thought I'd get over it. I had clients emailing me, what the hell are you doing? 2 days, we're down 10%. That is terrible. What am I paying you for? Of course, you know, that's part of the job. I got that. I said, be patient. I said, I think this news is a very short-term event. I still believe in what this company does, which makes paper products mostly for the tobacco industry. People aren't going to stop smoking, unfortunately. So I held on. Now, this is as of the other day, we went from a 10% loss to a 50% gain. In a matter of, 7 months, we've made 50% in the market. It's not too shabby. It doesn't always work that way, but you know what? If it would have broke our system and it would have broke our 12% stop, we would have been out. But we did not overthink it. We kept faith in our system, and we had patience. Very, very, very important. It's tough to do, and it takes years, if not longer, to figure it out. Some people just naturally have it. But I will say this, do you know how you get patience in the market? By making mistakes and losing money. It's the only way to do it. You could paper trade all you want, but when you actually lose money because your lack of patience, it means a lot more when it actually hits your wallet. Okay, strategy number one. We have three strategies we're going to talk about here today. Buy on weakness, buying the breakout, which is very big because we got a big seminar coming up next Tuesday just specifically on buying breakouts. And then, of course, one about selling. I rarely talk about selling, which is so important, but the number three strategy is about selling. So strategy number one is buying on weakness. Number one, forget about buying low and selling high. I know you've been taught that by so-called experts for many years, that you want to buy low and sell high. Sure, I get that. You want to buy at a low price and sell at a higher price. Of course, we're all out here to make money. But by buying on the low and selling on the high, Wall Street's selling you something that's not realistic. You can't always buy on the low and can't always sell on the high. It's much more difficult than it sounds. You want to buy, as we mentioned in that chart of swing trading, buy near the low, sell near the high, that's fine. But forget about buying low, because if you don't buy at the low, you beat yourself up. It's not realistic. You want to buy into value. When you see a value in an ETF or a stock, that's what you want to buy into. Oftentimes that coincides with a stock that's pulling back, which just means buying on weakness. We want to buy, though, on support, not just weakness. I'm going to flip over to a chart here really quick just to give you an idea of what buying on weakness is not. BlackBerry, for example. Here's a chart of BlackBerry, a long-term chart of BlackBerry. As you can see, this is more than weakness. This is just flat out ugly. I did a webinar this past week for Marketfy, and somebody asked me about BlackBerry, and I said, well, this isn't buying a weakness. This is a stock that's fallen from 100 down to 8. It just had more terrible news on Friday. You're trying to catch a falling knife. There's a big difference between that and buying on weakness, just so you know. By buying on weakness, what I mean is it's not every ETF is going to go straight up. You're going to have periods of time over the years where they underperform and they struggle. We want to use that, use that to our advantage, and take advantage of the fact that certain ETFs get pulled down for whatever reason it may be. It may be ETF specific, it may be market specific. For whatever reason, people sell from time to time. It offers a better reward to risk setup because the closer you buy to support, the less risk you're taking, and the lower you buy, the higher profitability, profit potential you have. So that makes perfect sense. And do not fear buying on weakness. This is something I talked about last week. I was in Fox Business last week, or Fox News, and I was about to go on air. Believe it or not, you're going to make funny, but sitting in the makeup room getting makeup, and sitting next to Jerry Willis, who's a host of a show on Fox Business, and has been a host on CNN all over the place. And so she's had a lot of years in the market, and talking to a lot of experts in the market. We were talking about the market, and I said to her, what do you fear more? Having a winner that's up 40 or 50%, an ETF that's up big, or having a position that's down a big, 40 or 50%. She said, oh my goodness, the winner, of course. I said, you know what, you're the norm. You're the masses. You make about 99% of the investment population. And she laughed. I said, it's amazing to me how our emotions screw up our investing. It really make it tough for a human being to be profitable investing, because you're more concerned about that position that's up 40 or 50%. You should be happy about it, and having a stop loss in there to lock in that gain, or banking it and being happy and taking a profit. You're more concerned about that than a position that's down 40 or 50%. A position that's down 50% must double. You need that position to go up 100% to get back to break even. How often do you see positions go up 100%? Not that often. So you're more concerned with the winner than you are the loser. You should be concerned with the fact that you lost half your money on a position. So when it comes to buying, the same type of attitude goes into it, where people fear buying on weakness. When the market hit highs a few months ago, I had everybody saying, give me a 5% pullback, give me that 7% pullback. That's all I want. I want to buy a little bit cheaper. I don't want to buy at the high. You know what happened when that pullback came? And again, I'm going to flip over here and show you something. To show you the Spiders ETF. When that pullback came, it was right here. The pullback came, I think there's about a 6% pullback. What happened? CNBC, Fox Business, they're all guilty of it. Bloomberg had all the bears back on, who are right once every few years, and all the bears are saying, oh my God, it's the end of the bull market. You must sell. You must get out. Investors believe them for some crazy reason, because they've been bearish for the last 30 years, and they're right every once in a while, just like a broken clock. The bears are terrible because the long-term trend is up. Sure, certain times you must be bearish, but when you hear these guys and gals come on CNBC and stuff, ignore them, hit mute, please, turn the channel, do something. Go get a coffee, have a cigarette. So the market pulls back 6%. This is when you should be buying. And if you follow us on MarketForce, if you're a member or get some of our free updates on MarketForce, you know darn well it's documented. I was saying do not sell, do not sell. We are buyers, and we were actually buying down here because we had to pull back to what we wanted because nothing goes straight up. We did not fear the weakness. We did not fear cheaper prices. Do you get scared when you go into Walmart and something's on sale? No. You love it. You take advantage of it. When something's on sale, you're buying. You want to do the same darn thing when it comes to the market. Again, you're not buying BlackBerry because something's wrong with it, but you're buying into a position that you believe in that's selling at a discount. All right, I'm not going to hammer that too much, but you get the point. You do not want to fear the fact that something can pull back. This is the EG Shares Emerging Market Consumer ETF. So invest in a basket of consumer stocks based in the emerging market. Has greatly outperformed the emerging market ETF. But what I want to show you here is buying on weakness. As you can see here, this broke out to a year high and then had a major pullback. We all know what happened to the emerging markets. As tapering started to come into the language of many investors, people feared that the emerging markets will get crushed. And as you can see, all emerging market ETFs got hit hard. This tried to rally back, but it pulled back again. So here's your opportunity. We have what's called a double bottom. It didn't break the low here. The ETF came down. This has been outperforming the emerging market ETFs. The emerging markets are great values. I still believe in their growth. They're growing faster than the S&P 500, or faster than the United States and developed markets. So why not take a shot here? What's your stop loss? You have support right there. You could break through that easy and have a very small loss if it goes wrong. As you can see, it held that double bottom and rallied. That chart was a couple of days ago. Let me give you an updated one right now. As you can see here with ECON, it rallied, and then we pulled back the last couple of days with everything else. But this is a big, big rally. This is a move from 24 to 28. That's nearly a 20% rally in a matter of a few weeks, just buying on weakness, buying into that fear, getting rid of that fear and saying, you know what? It bounced here last time. There's a good chance it bounces here again, and it certainly did. So that is what's called buying on weakness, and there's a lot of examples out there right now of some emerging markets and other ETFs that have kind of been out of favor, and it's okay to buy out of favor. There's nothing wrong with it. At the same time, strategy number 2 is buying breakouts. This right now is the most important strategy for the fourth quarter. This has been the most important strategy for a majority of this bull market in the last few years, and in my mind will be the most important strategy probably again in 2014. That is why Kyle will talk about at the end of the webinar here. We're doing a special webinar just on this, just on buying breakouts, where I give actually ideas, my 3 favorite ETFs that are breaking out and prices to buy, when to buy. So 3 really ideas you take away and you know when to buy, coming up next Tuesday. But let's give you an example and kind of educate you here a bit on how to buy the breakout. So they're initially identified by a stock or an ETF that's breaking out. It may be breaking out to a new all-time high, new monthly high, weekly high, whatever it might be. It may be breaking above a resistance level, maybe breaking above a trend line or an indicator such as a 50-day moving average. So there's a couple different ways that you can identify a breakout, but typically, visually, they're very easy to identify. You can clearly see it breaking out on the charts. What we must do is we must look for a pullback. We do not want to chase a high. Very tough to do, as I mentioned. It's tough to buy on weakness. It's tough to buy on a pullback. It's much easier to buy when an ETF is hitting a high, or any stock or any position hitting a high. When the market's down and I turn to my left, I look at my big screen, I see on CNBC the Dow's down 180 points or whatever it was on Friday. It's much tougher to buy when the market's down 180 points because you believe that, wow, what the heck am I doing? I must be crazy from buying into this market. It's much easier to buy when the Dow's up 180 points. But the problem is you're buying the Dow up 180 points. You're buying it up 1%, over 1%. Don't you want to be buying on weakness and getting a better price, or do you want to pay a premium for something? Well, people pay premiums because they feel better about themselves. When you go shopping, you buy something at Saks, well, you know what? The perfume's got to smell good. I got it at Saks. Versus the perfume I bought at TJ Maxx, that's probably smell too good. I got a TJ Maxx. It's perception, but unfortunately, perception becomes reality. So we must look for pullbacks. The key is a healthy pullback. Anybody who's followed myself or Penn Financial Group over the last decade has known I've given this speech, webinars in Europe and Asia, everywhere you can imagine, talking about healthy pullbacks. What I mean by that is once an ETF, a stock, or even an index breaks out, you look for that pullback. You don't chase. That pullback must be what I term healthy. Again, I wrote about this in my second book as well, The Next Great Bull Market, about the healthy pullback. A healthy pullback occurs after a ETF breaks out and then naturally pulls back to that breakout level. We're looking at a chart here of the Spiders S&P Biotech ETF. So it's a basket of biotech stocks. I'm going to use this as an example as I really give you a definition of what healthy pullback is. You can see XPI rallied up to a high around $113 per share. It rallied up again to around $114 a share. Couldn't get through this, so that's now resistance. That's a double top. It pulled back and once again rallied for a few days, could not get above that 114-ish level. So now we have what's called the triple top. Finally, a few days later, it breaks out. And you see the volume coming in on the upside. We have volume increasing. And as you can see here, volume increases as we move on the upside. So we have volume coming in. We have conviction. We have an ETF breaking above a level that it has not been able to get past ever in the past, and we're doing it on more buyers. That's extremely bullish. So there's our breakout. The breakout's taken care of. And then from there, we want to have what's called a healthy pullback. We consolidated a bit and kept going. No reason. I was following this. I wasn't owning it. I wasn't buying it yet. But then we started to pull back. As a matter of fact, we pulled back, what, 9 out of 10 days we pulled back. But what we did is we pulled right back to this level, this white line. That was our old resistance level. When resistance is broken, it does a role reversal, it turns into support, and vice versa. This is now our support level. We pulled all the way back to support. We also have this blue line, which has been pretty good support along the way, except for this one break, but it's been support very good. That's our 50-day moving average. So we had this ETF pull back to its 50-day moving average. We had a pull back to price support here at a former resistance level. And we have what's called the RSI, which is giving us a buy signal, which I don't want to get into because it's too complicated, but it's another indicator that we've used, and we've done a webinar on this in the past, giving us a buy signal. So we have all the technicals going for us, and it's healthy because it's held the support. If we blow through this, it's not healthy. So let's take a look here and see what actually happened with this chart. Well, I'll tell you one thing, what happened. That's where we left it right there. I'll tell you what we did. The next day, right here, we put in, sorry about that, we put in a buy alert for MarketForce investors or subscribers right there on the 20th. We put in a buy. We bought right there, right on the support. And what did the ETF do? We got a buy signal here. We had big volume come in, and it rallied. And we're now sitting at a new all-time high in XBI. I will say we did sell this in 6 days with a 6% profit, so I'm not too upset, but sure, we could have made a lot more money on this ETF. We left some money on that table that nobody knows where that table is. If you find that table, let me know. But we left some money on the table for sure. But again, we're not going to be upset with making 6% in 6 days. So we bought on support. And buying on breakouts sound easy. They're fairly simple to identify. I will say that. You can identify them pretty simply, but it's very difficult to know when to buy. Are you buying here and this foolish pull back here? Are you waiting for it to pull all the way back? Here at MarketForce, this is one of the strategies that we use on a daily basis. And most of our buy alerts that have been going out for subscribers in our ETF portfolio have come from buying the breakouts. And this I could honestly spend days on. But I'm going to spend an entire hour on this next Tuesday. We're going to talk about that at the end, an offer that we're having. I'm going to give you an entire webinar on how to buy these breakouts and break down these charts and put the volume, put RSI in there as well, trend lines, and break it all down so you know exactly when to buy the breakout, how to identify it, number one, and number two, more importantly, how to buy it, and number three, which most people never tell you how to do this, how to sell, when to sell and when to get out, which leads me to my next, oops. Oh, okay. This came in there. I got to put this in there. Kyle's going to get to this later, but how to buy a breakout, just so people know. Get this in your heads now. I'm not going to talk about it, but we're doing it next Tuesday from 6 to 8, actually 2 hours. So we're going to talk about this at the end. But strategy number 3, I just talked about selling something that I'm guilty too. When I do webinars and I do seminars all over the place, a lot of times I don't say I ignore selling, but so fixated on when to buy that oftentimes you forget about teaching people how to sell. And here in these webinars, I try to mix a little bit of both. It's the old teach a man to fish or give him a fish. Teach a man to fish, you can fish the rest of his life, that kind of stuff. You give him a fish, he'll eat for a day. I like to do a little bit of both. I like to teach you for sure, but I also like to throw a couple of fish your way. And I mentioned I was in Alaska maybe about a month ago for some business. A company flew me up that I'm promoting and did some salmon fishing. I said, I'm not much of a fisherman. And they go, we'll teach you. I'm like, I really don't care. I don't care to learn because in Manhattan, I'm not fishing in the Hudson River and the East River. I'm just not doing it. I'm not even stepping my toes in that river. I don't want anything that comes out of it. You got bodies floating down there, if anything. No, I don't want that. They said, well, don't worry. We're also going to guarantee you catch some fish. So I thought, okay, that sounds good. It sounds like a great way to promote a product because not only am I going to teach you how to play the breakout, how to sell, but at the same time, throw you some fish. So at the next two slides, I'm going to throw you a couple fish. I think Kyle and the guys at Benzinga always say, Matt, don't give away too much. But I'm going to give away a little bit, not too much. They know I can't get them mad at me, but they're the big bosses. But I always like to throw something out to you. So we're going to throw some fish your way. So don't worry, I'm teaching you, but I'm going to throw you some fish. So something I need to teach you is when to sell and what I like to call bank profits. Number one, it's okay to sell. You'll be surprised when I say I believe in buy and hold, because most people say, no, you're crazy. I do believe in buy and hold. But what I do not believe in is buy and ignore. And I think most people who say they do buy and hold are really doing buy and ignore. They buy a position and they ignore it. I always find it amusing when, before I started Penn Financial Group, I worked at Charles Schwab and some other firms, and when you'd come in, they'd be like, okay, here's $100,000, Mr. McCall. Okay, John Doe, we're going to take your money, we're going to put it in 5 mutual funds, and we'll buy them all tomorrow, and I'll talk to you realistically in probably 2 years. It doesn't matter what the market does, we're going to put it in there, we're going to get our fees, and we're going to move on to the next client. I thought that is the craziest way to do business because you have no idea, you have no strategy, and you have no strategy when to sell. The other thing is if you come to Penn Financial Group, we don't buy everything next day. We have a plan, but we buy over weeks or months or days to make sure we buy at the right pullbacks, and we may sell before we even buy the next position because things may go wrong or may have a big winner. But you have to know when to bank your profits. Remove the thought that you'll sell at the high. Just remove the thought that you'll sell at the low. You're never going to always buy at the low. You're never always going to sell at the high. If you think you're always going to sell at the high, like XBI, for example, the biotech ETF, sure, I can be pissed at myself right now because I could be up 12% versus taking 6% profit in 6 days, but I never met somebody who went broke taking a profit, banking a profit. And I know that that's a cliche and you can say it's kind of corny, but it's true. So we're going to use the charts to determine when to have you sell. Again, I could give you 20 ideas today, 20 fish thrown your way, the top 20 ETFs I like. And I do that from time to time. I throw out emails or I talk to people on TV, I give away ideas, and then they come back to me. I do this a lot at the Money Show. So I go to the Money Show and I give away my top ETFs for the year. And then they'll come back next year, Matt, you know what, I bought this ETF and it's down. What the hell happened? Well, first of all, the other 6 are up. Thanks for mentioning that. But more importantly, we actually never bought that one. We were giving you ideas. But if you were a subscriber, you would have known that we didn't buy it. Or we bought that ETF and we sold it months ago. We took a small loss or we banked a profit, whatever it might be. People don't realize that you actually have to do some work and you have to follow and have a strategy. Here what happens is people will take ideas and they don't have anybody helping them or guiding them. Here at MarketForce, we're going to guide you. We're going to tell you when to buy and sell. So keep that in mind. That's important. And of course, we use these charts to determine when to buy and sell. Overall market's a factor as well, because if overall the market's struggling, the market turns down, we're going to want to have less exposure to equities, so we're going to sell some positions. And keep that in mind. That goes back to my top-down macro to micro approach. And again, as I mentioned just a moment ago, never go broke taking profits. And my example I'm going to use here is Disney. Look at this chart on Disney. This is a high. It rallied up here so many times. We talk about hitting what they call a double top, triple top. You hit the 68 level, hit it again. And then Disney came out and said they're going to do a huge multi-billion-dollar buyback program. As you can see, the stock rallied, 1, 2, 3, 4, 5, 8, 10 straight days in a row. right to this old level and then started pulling back a bit. Let's see where it is today. This is from a couple days ago. Look at this. This wasn't planned because obviously I put it in there. Came right up to this high. And I can zoom out and show you that is an all-time high in Disney. We hit an all-time high basically 4 times. It's a quadruple top. That's pretty darn bearish. And when you sell, you look at volume. If it's pulling back on light volume, it means the sellers aren't overwhelming. The buyers are taking a breather. Look at this. On Friday, we've had the biggest volume basically of the year. This is, that's last year. Biggest volume of the year, hitting that quadruple top. And I did this seminar last week, and I said this is a sell signal at 67, and now we're down to 65. You could have saved yourself $2, but that is a sell signal. You know what? You're happy that you're up 10 of the last 11 days. Let's sell this and get out and be happy. We can always buy back in. At the same time, you have the RSI way up at the high, 99.5. It only goes up to 100, so very overbought at that level as well. So it's okay to bank profits. And again, here at Marketfy, we watch the charts every day to tell you, you know what? Disney may go higher. It may be higher by the end of the year, but right now we think it's going to pull back. We're going to take this and bank our profits and catch that swing. This is swing trading. Catch the swing up, and we got it, and we'll get out. So just a couple ideas. These are not ETFs we own. I'm not necessarily saying go out and buy this ETF, but just give you an idea of some real life buying on weakness. This is the iShares S&P Latin 40 ETF. ILF is a symbol. We looked at Econ earlier, which is the emerging market consumer ETF, how it formed a double bottom. This is almost a quadruple bottom. You can see hit here, rallied, hit here, rallied, hit here, rallied, hit here, rallied again. The difference is every time we rallied, we hit 37. We've been between 35 and 37.5. We recently broke up above that 37.5. We closed Friday just below 39. This is a breakout. Not only is this buying on weakness, which it is, it's also a breakout. We broke above a resistance level. Now we want to have what's called a healthy pullback. As you can see, the breakout volume is pretty high the last 2 days, even though this is an ugly down day. Much lower volume, half the volume than the breakout. So let's see if this pulls back to 37.5, 38. That would be our buy signal. Again, I'm saying this because I like what's going on, and this goes to our subscribers who, again, get updated watch lists. We give an ETF watch list. We sent out one this week, an updated ETF watch list. This was on there. ILF was on there as one of the ETFs we're watching. Does it mean we're going to ever buy this? No. Does it mean that we may buy and sell in a day? No. Does it mean we buy and hold on for 10 years? No. You don't know because you're not a subscriber. If you are a subscriber, you'll know if we buy it because we'll send you a real-time alert. You'll know if we ever get out of it because we'll send you a real-time alert. And you'll also know if we never buy it. It may break through it, then go right back down to 35, and we keep away from it. Or you know what? Maybe we buy it at 35 at a quintuplet bottom. But as a subscriber, you'll know. But I will say this is a buying on weakness, and this is a watch list ETF. Identifying winners on breakouts. As I mentioned, we're doing an entire webinar on this next Tuesday from 6 to 8 Eastern Time. I'm happy. I thought it was an hour long, but I just found out today with you it's 2 hours long. So I got 2 hours of sharing this with you. And honestly, I saw the price on there, and I got to tell you, I'm happy, but I'm not happy. $39 for 2 hours of my time. Not to sound conceited, but you're going to get a hell of a lot of information, education, and 3 ideas for $39. That's $13 an idea. Where normally I would charge much more, but I got to tell you, I love everything Marketfy is doing. I love helping the investors out there. I'd love to give it away for free if I could, but we got to keep the lights on here and Penn Financial and at Marketfy. So we got to charge a little bit. So we're going to talk about that in a moment, but keep in mind that is an amazing opportunity to identify winners by buying breakouts. Here's one. Again, we put this on our watch list. We do not own this. We don't even own this for clients right now. But what I found here was an amazing breakout. As you can see, CUT is a Guggenheim Timber ETF. It's a basket of timber stocks. How many people even thought about timber stocks? Probably not many. Not only is this ETF, I'll give you a little tidbit. Looking good in the charts, which I'm going to talk about in a moment, this also falls into a mega trend because I truly believe that inflation is going to be a major issue for us going forward. And do you know what sectors do well during inflation? People say gold. Yeah, gold does okay. You know what does even better? Timber, land stocks do better. And that's what this is a basket of. And so if inflation comes, this ETF should do very well. At the same time, it will do well in this current environment, as you can see it is, because there's a higher demand for housing right now. The housing market's improving, higher demand for timber. At the same time, global demand for products and services is still Good. Not robust, but it's still good, which means more demand for paper and packaging goods, which is good for timber stocks. So you got a bit of a trifecta going on here, and you add in a great chart. This broke out this last week and a half, and it's big volume, it's pullback. The one thing, what flag is, it's pullback on some big volume on Friday, but the healthy pullback is starting. So we've had this clear resistance level here, as you can see, around 2360. You know what we also have coming up is this blue line, it's a 50-day moving average. So between 2340 and 2360, we have very important support levels. If this pulls back to that level, there's a good chance we could buy it. But if volume picks up, we may stay away from it. We also are getting a sell signal on the RSI, so it keeps us from holding our finger back from the trigger and not pulling it until we hit the support level. Once it hits this support level, you will know. If you're a subscriber to MarketForce, we will send you an alert saying we're buying Guggenheim Timber ETF at this price. This is why. Not only do we not give you buy signals that are real time, we also tell you every time we buy and sell why we're buying and why we're selling, because we're going to continue to educate you and teach you to fish along the way. We'll give you your fish, you'll get your salmon, but you're going to get some instructions on how we caught that salmon and how to eat that salmon once you get it. So this is an idea here for breakouts. And again, we have a full 2-hour webinar coming up on Tuesday. Some of our recent winners and stats, because people say, Matt, I don't give a rat's you-know-what about learning to fish. I just want the darn fish. And I get it. Some people just want it. You're too busy. You don't care. You're not interested. You just want to make money. I mean, realistically, we all are here to make money. Sure, education's great. Sure, this is fun. But you want to make money. That's why we're in the market. So just give you an idea about MarketForce. As I mentioned, MarketForce follows a strategy that we've had around for over a decade, something I've used. I've written books about it. But this actual ETF newsletter, which we started with ETF Bulletin. I said, Kyle, I think we need to do this. I think this is what subscribers want, what people want, investors want. So we started this on July 22nd, my little sister's birthday, so I'll never forget that day. So far, we're outperforming the S&P 500 in that time frame, quite dramatically, I will say. We currently have 7 ETFs in the portfolio, 31% cash. So we got about 3 more positions we're going to get into. And the market broke out this week on Wednesday, pulled back Thursday, Friday. I truly believe we're going to do a lot of buying probably in the next week or two, and may even do some selling and then rotate some money into the market. I think this pullback that we're having now is a healthy pullback, and we're going to be doing that, some buying. So you want to be in as a subscriber to get our buys when they come out. Some recent winners, as I mentioned this a couple of times, we bought and sold this in 6 days, not 6 trading days, actually 6 calendar days, 6.1% profit XBI. Here's more of a longer term one. This is one that we bought and sold, the First Trust Cloud Computing ETF. This is also a MegaTrend ETF. We bought it on the 23rd of July, sold it on the 10th of September. We made it about 6.6% in 7 weeks. So about, 0.9% a week? If we can keep that up, again, track record, we're going to make a boatload of money going forward. I'm going to show you this guy just real quick, because this is an example of one that we bought and we sold, but it kept going a little bit higher. I got to tell you, I think this is overdue for a pullback, and if we pull back to this breakout level around 24, we sold at 24, 28, we could easily buy back into this. I wanted to bank a profit. I wanted to get a nice winner in there, show the subscribers out there, we're making money. Let's bank one. Let's move on from here and get the next winner. Good chance we get back into this. Again, as a subscriber, you'll know when we would get back into that ETF. But these are real examples. We have not had any losers yet, any realized losers, which is great. We've only been around 2 months, but again, have not had any realized losers. So far, so good. I'm happy with what we're doing here. And our goal is to beat the S&P 500 with what I believe to be less risk. We're sitting at 31% cash. Keep in mind, when we started this 2 months ago, we didn't go right into the market. We went little by little, buying. So we took much less risk. So we're beating the market with not even putting all our money to work yet. So that's even more important. Risk adjusted, we're blowing the doors off the market. So you must have a plan. 3 things you have to have, and I don't want to get too much in this because I want to leave time for questions here very, very quickly. Money management. You must know what your position sizing is. Here at MarketForce, we tell you, okay, we're putting 10% into this ETF. So you have to take that and use that for your own portfolio, but we give you an idea of how much you should have for position sizing. Risk management, reward versus risk. What's your initial stop loss? We give you stop losses. We tell you when they get out. We will not let you get in a position where you buy BlackBerry and you own it 2 years later and you're down 80%. That will not happen with us. We will get out. We will honor our stop losses. Just as important, profit management. What do you do when you have a winner? Do you freak out and get scared? No. Do you let your winners run and cut your losers short? Yes. But do not be greedy. We'll make sure you are not greedy. We will tell you when to sell your positions. The rules are to have a plan. I just went over. You must have a plan. Remove emotions. You cannot do that fully. We will help you with that. You must use the charts. People say charts are voodoo. What are you using charts for? That's malarkey. Everybody uses charts. All big investors use charts. You must have an exit strategy. Target and stop loss. Selling is okay. Do not fall in love with the position. We won't let you. Patience is a virtue. We will be your patience for you. As you can see, we are doing this for you. We can help. We have a plan. We stay abreast of the markets. If you can't tell in my voice, it's 9 o'clock in New York. It's a Saturday. This city never sleeps. People don't go out till midnight on a Friday night. And I have a lot of energy because I love what I do. If you can't hear it, you've seen me in person, you've seen me on TV. I love the market. I will work probably 3 or 4 hours today, probably 3 or 4 hours tomorrow as I watch the football because my Eagles already got beat on Thursday. So I have time to work, and I love doing it. It's my full-time job. We're going to help eliminate some of the buy and hold pitfalls that you have. And what I love about this membership here, this newsletter, it works for 401ks, IRAs, trading, anything. We can help you on all levels, which is great. We'll help you eliminate those emotional, terrible decisions you make when you freak out in the market selling and you sell at the lows. And our ideas are generated from a proven strategy. Students speak. Marketfy always put this in there. I'm not going to read that, but just some feedback from some of the subscribers that we have talking about things that we've helped them with in the past. And then now I'm going to stop talking for a minute because we're going to get into some Q&A. I know there's a lot of questions out there. If you don't have questions yet, type them in, and then pass this on to Kyle to talk about our webinar coming up.
Cool, awesome, Matt. Awesome stuff, dude. I always love learning about your ETF strategies and just watching what you've done here. It's pretty cool. So we do have an offer here, and then I'm going to get to Q&A. So the special offer we have today is what Matt's referred to, and that is a 2-hour live seminar, which you'll also get the recording on how to buy on a breakout. He's also going to be talking about 3 ETFs that are going to win in this market. So he's going to be talking about 3 specific trades as well, okay? The 2-hour live seminar is Tuesday, September 24th, 6 p.m. to 8 p.m. Eastern Time. And again, the recording will be available for everybody, okay? So even if you can't make it during that day, don't worry. You'll still get sent out the actual seminar. You're going to be going real in depth with Matt. Today he's only got 40 minutes to go over some strategies that he's doing and he's implementing inside not just his Penn Financial where he's managing money, but also on his subscriber portfolios. And then you'll also talk to him again about his 3 specific ETFs, be able to ask questions about them, pull up charts, a ton of interaction and Q&A. The last time Matt did one of these, I think it went like over 3 hours. So I'm sure any questions you guys have for him will answer, okay? And I'm going to drop that link in the chat right now. So go ahead and check out. It's the URL is vip.marketfy.com/breakout, okay? How to buy in a breakout. Let us know if you guys have any questions about the seminar as well, okay? John and a couple other people, yes, if you can't attend the webinar or the seminar and you pay the special price, you will get a recording of it, okay? So make sure you check that out. All right, a couple questions here, Matt, and I'd love for you to go over this real quick because we only got about 10 minutes left. And do you actually scale in and out of your positions?
Question is, do you scale in and out of positions? Typically, I'm going to go all in, all out. Scaling out of position would be, for example, if we put 10% into XBI, let's say, and we see 6% profit in 6 days, we sell half. And then what we can do is let the other half run. Sure, I do that for my clients for positions. With this, I haven't yet. I don't rule it out. But with swing trading, not as much. But there will be certain situations where we buy, and then, you know what, it breaks out again. We might buy more because I still like where it is. I want to over allocate to a certain position. It could be done. I have not done it yet, though.
All right. I have a question, and a couple people are asking about this. If you hold positions below the 50 M&A, which is moving average, the drawdowns must be tremendous if you're buying breakouts and holding through pullbacks. Can you explain the trading strategy and thesis behind that?
Of buying stock, well, typically, if we're going to buy a ETF and a breakout, it's going to most likely be above the 50-day moving average. Especially if we're breaking out something to a new multi-month high. So, yes, it's going to be above the 50-day. If I'm buying a buy on weakness, sure, that might be below the 50-day moving average. But keep in mind, I want to show you a chart real quick just to give you an idea. The 50-day moving average is great, but there's also, I'm going to try and find a stock here. There's also a lot of positions out there where the 50-day moving average is irrelevant. I just pulled this up just randomly, but as you can see, the 50-day moving average is a blue line. It doesn't mean crap. I mean, it doesn't really mean anything, because if you sold here, it kept going. If you bought here, it kept going. It just goes up and down. So each position is different. That's why when you look on the chart, if 50-day moving average has proven to have been support or resistance in the past, the importance is very relevant. If not, it's not very relevant. So I love the 50-day, but it doesn't work for every position.
All right, and that was, I also got from Miss Amelie, is it a 50 or 15-day EMA? Is that EMA or SMA?
It's
Matt?
a 50-day simple moving average, SMA, 50.
Cool. All right, great. And then inside your seminar, in the ETFs that you're going to be talking about, do you have specific sectors you look at?
Yes, of course. I mean, part of the top-down approach is looking at the market as a whole and then breaking it down from there to sectors. And of course, right now the trend is higher, so we want to invest with the trend. The trend obviously moving up. You want to look at some of the top-performing sectors out there. Some of the material stocks sectors have broken out as of late. As I mentioned, timber is a sector that's broken out. So many of our ETFs that we're going to recommend in MarketForce, and a few that we're going to talk about on Tuesday's webinar that we're doing, are going to be sector-based. Because what the beauty of an ETF is, if you believe in, let's say, the timber stocks, you believe in that MegaTrend that I talk about, or the auto stocks, that trend. I own Ford Motor, for example, for my clients, but if you want to just not take that company-specific risk and take away that fact that they have earnings every 4 quarters, you have to worry, you suffer through earnings, you can go to the ETF, because if you believe in the entire sector is going to move higher, you find the ETF that tracks that sector. So you can, instead of buying Ford, you buy cars. Instead of buying into, let's say, Ryanair, which is a timber stock, you buy into CUT. So you lower your risk dramatically by not lowering your reward that much more. So it's a great reward to risk. So yes, we will look at sectors over and over, and we're going to talk about them a lot in this webinar we're doing next Tuesday.
All right, Matt, only a couple minutes left. I got Brad D asking, do you recommend short positions or strictly longs because of the IRA account restrictions on shorting?
Well, there's no restriction on shorting if you buy into an ETF that actually shorts the market. So for example, you can buy into symbol SH, which is basically the short S&P 500. So if you believe the market topped on Wednesday and it's going to crash, you would buy into SH, and that would actually do the inverse of the S&P 500. If you believe gold is going to continue to move lower, which I do believe, you can own DGZ, which is a short gold ETN. And as you can see, gold was down big on Friday. This ETF was up 2.2%. So yes, I will definitely use some short positions, but I will not tell you go out and short this ETF. I will use inverse ETFs, which do the shorting for us and do the inverse of whatever index that's tracking, so it can be used in IRAs, 401ks. And as a matter of fact, if I see the market rolling over, which we're not going to go up every day or every month or every year, we will try to take advantage of it by looking at maybe an SH or some type of sector ETF that will do the inverse of that sector.
Besides the cost of commissions to buy and sell, do ETFs have any other fees?
Yes, ETFs do have fees, and you can find that whether you go to Yahoo Finance, Google Finance, or just the iShares if you're buying an iShares. They typically range for a larger ETF about 0.3 to 0.4%, so 30 to 40 basis points. And what I love about ETFs, and why one of the many reasons I invest in ETFs over mutual funds, and I own 0 mutual funds, I'll never buy a mutual fund again in my life because they're garbage, is the fact that they're so much cheaper. Where an actively traded mutual fund, you're going to be paying upwards of 1.5 to 2%, sometimes more, versus paying, let's say, 30 basis points. For example, some of the Vanguard ETFs are 10 basis points. So you're paying 1/15th or 1/20th of the fee that you're paying for a mutual fund. And keep in mind, ETFs are passive. Almost all of them are passive. Mutual funds are active. Mutual funds have the old 80-20. Only 20% of actively managed mutual funds can beat their index they're tracking, where if you always want to buy that index, you buy the ETF for a lot less. So you're paying in a mutual fund more money to underperform. That sounds like it makes sense, huh, Kyle?
I would say so. I think we could do an entire other webinar on mutual funds versus ETFs and the trend right now.
Yep.
All right, folks, I got some more questions coming in. Make sure to, if we don't get to them all right now, we'll make sure that we get you out some answers from Matt after the webinar and also the recording for you, okay?
And keep in mind, too, not to cut you off, Kyle, but as a member of MarketForce, you can email me anytime and ask questions. I can get back to you as well.
Absolutely. Matt's very good about that on Marketfy. We got Jack W. that came in and said, Eagles fan in New York. You must be popular. I live in Eagles territory.
Yeah. I get a couple yells when I go to watch the game at the pub. Thanks.
Dwight W., I have heard that ETFs are good for day traders because they rebalance daily. How does that play into a buy and hold for a short period of time?
First of all, ETFs do not rebalance daily, so that's not true. There may be one or two out there that do, but most rebalance on a quarterly basis because they track an index. So yeah, that's not true. So what you may be referring to is that the leveraged ETFs, if you're leveraged 2 times, you could buy an ETF that goes 2 times the S&P 500. That goes 2 times the S&P every day, resets every day. That may be what you're talking about. That's good for traders, but no, ETFs are not reset every day.
Chris, Jacob, Stephanie, yes, we will have recordings for Matt and the rest of the presentations available by tomorrow, okay? All right, what else do we got? We got a question. So right now with your portfolios, and Matt, you also run the ETF Bulletin and Market ETF Force. How are your portfolios performing right now, and what do you see for the fourth quarter?
MarketForce, as I mentioned earlier, is beating the market. We started July 22nd, so tomorrow will be our 2-month anniversary, and we're on pace to beat the market by over 10% on the annual basis. So we're doing very well. Again, with much less risk, and because we didn't get right into the market immediately, so that's kind of amazing to me. We're doing that well. And what do I see for the fourth quarter? I see the fact that the market's going to keep moving higher. We hit an all-time high on Wednesday. A lot of the people who do what I do don't manage money. Number one, I manage money, so I put money behind it. Number two, I'm on television 4 times a week. So you can, if you know me, I've been bullish since the market bottom. I wrote a book at the market bottom on the next great bull market. I believe that will continue. And that's not just me talking, try to get you to sell a newsletter. I truly believe you want to be long this market. At the same time, you need to be selective. You're not throwing darts like the 1990s. So I believe the market will be higher, but I think you have to be in the right ETFs, the right sectors, the right countries, and you must manage those, and we're going to manage those for you.
All right, real quick, because we only got about 2 minutes left. How do you, and will you be teaching this inside your special seminar about entries and exits and how to look for those? And also, what is the max duration that you're holding?
Yes, we will be teaching that, not only a breakout, as I mentioned, we'll be teaching you how to identify the breakout, but also how to get out. You need to know how to sell. So we'll be doing that as well. And again, we're giving away our 3 top ETF picks, too. We're giving away not only teaching you to fish, we're throwing a couple of fish your way. Maximum holding period, as I mentioned earlier in the webinar, there isn't one. There are ETFs that we bought that we had the mindset that we're going to hold it for a few weeks, a few months, but if the trend continues and it does not break support, and the reason we bought that does not alter at any time, we let the winner run. We will take our stop loss and continue to move it up and lock in that profit, but we will let that baby run as long as it wants to run.
All right, and just to wrap up, we got JA8669. Does this work with E-minis, S&P futures, these strategies you're talking about with the breakouts?
Absolutely. I mean, the technical analysis works whether you're trading E-mini futures, whether you're trading Euro, whether you're trading Cocoa. Everything moves in a chart. So yes, when it comes to a chart, you can use it for anything. And what's nice is a lot of the things I mentioned, the Euro or Cocoa, there's ETFs for that as well. And those may be ETFs that we buy in if we see the chart doing well and it has a mega trend behind it. So the charts, what's great about technical analysis, it can be used in anything. Anything in the market that moves, the charts can be used.
All right, folks, keep bringing your questions in. You can email them us at support@Marketfy, and we'll make sure Matt gets back to you on those. Also, make sure you see the link one more time inside the chat room. Matt, I appreciate you getting up early, buddy. You brought it. I'm glad you did. We got a lot of great comments from here. I have hundreds and hundreds of questions right now. Thanks a lot, buddy. I'll be sure that you get those over and we get those answers. Enjoy the rest of your Saturday.
All right, thanks, Kyle. Make sure everybody here hangs on, too, and listens to the rest of the guys. You got a lot of education coming your way today.
All right, Matt. Thanks a lot.
Thanks.